Chapter 22 Accounting Changes in Error Analysis. Accounting alternatives diminish the comparability of financial information, obscure useful historical trend data. Types of accounting changes: change in accounting policy, change in accounting estimate, change in reporting NFT. Errors are not considered an accounting change. Change from one accepted accounting policy to another. Examples include average cost of LIFO, completed contract to percentage of completion method. The three approaches for reporting changes are currently, retrospectively, prospectively. FASB requires the use of retrospective approach. Retrospective accounting change approach. Company reporting the change. 1. Adjusts its financial statements for each prior period presented to the same basis as a new accounting principle. 2. Adjusts the carrying amounts of assets and liabilities as of the beginning of the first year presented, plus the opening balance of retained earnings. Reporting a change in principle. Major disclosure requirements are as follows. 1. Nature of the change in accounting principle. 2. The method of applying the change. And A description of the prior period information that has been retrospectively adjusted, if any. B. The effect of the change on income from continuing operations, net income, or other appropriate captions of changes in net assets or performance indicators, and any other affected line item. And C. The cumulative effect of the change on retained earnings or other components of equity or net assets in the balance sheet as of the beginning of the earliest period presented. Direct and indirect effects of changes. Direct effects. FASB takes the position that companies should retrospectively apply the direct effects of a change in accounting principle. Indirect effect. And any change to current or future cash flows of a company that result from making a change in accounting principle that is applied retrospectively. Impracticability. Companies should not use retrospective application if one of the following conditions exists. 1. Company cannot determine the effects of the retrospective application. 2. Retrospective application requires assumptions about management's intent in a prior period. 3. Retrospective application requires significant estimates that the company cannot develop. Examples of estimates: uncollectible receivables, inventory obsolescence, useful lives and salvage value of assets, periods benefited by deferred costs, liabilities for warranty costs and income taxes, recoverable mineral reserves, and change in depreciation methods. Prospective reporting. Changes in accounting estimates are reported prospectively, accounting for changes in estimates in 1. The period of change if the change affects that period only, or 2. The period of change in future periods if the change affects both. FASB views changes in estimates as normal occurring corrections and adjustments and prohibits retrospective treatment. Disclosure. Companies need not disclose changes in accounting estimate made as part of normal operations, such as bad debt allowances or inventory obsolescence, unless such changes are material. However, for a change in estimate that affects several periods, such as a change in the service lives of depreciable assets, companies should disclose the effect on income from continuing operations and related per share amounts of the current period. Examples of a change in reporting entity are: 1. Presenting consolidated statements in place of statements of individual companies. 2. Changing specific subsidiaries that constitute the group of companies for which the entity presents consolidated financial statements. 3. Changing the companies included in combined financial statements. 4. Changing the cost, equity, or consolidation method of accounting for subsidiaries and investments. Type of accounting errors. A change from an accounting principle that is not generally accepted to an accounting policy that is acceptable. Mathematical mistakes. Changes in estimates that occur because a company did not prepare the estimates in good faith. Failure to accrue or defer certain expenses or revenues. Misuse of facts. Incorrect classification of a cost as an expense instead of an asset, and vice versa. All material errors must be corrected. Record corrections of errors from prior periods as an adjustment to the beginning balance of retained earnings in the current period. Such corrections are called prior period adjustments. For comparative statements, a company should restate the prior statements affected to correct for the error. Comparative statements. Companies should 1. Make adjustments to correct the amounts for all affected accounts reported in statements for all periods reported. 2. Restate the data to the correct basis for each year presented. 3. Show any catch-up adjustment as a prior period adjustment to retain earnings for the earliest period it reported. Changes in accounting estimate. Employ the current and Why companies may prefer certain accounting methods. Some reasons are political costs, capital structure, bonus payments, smooth earnings. Companies must answer 3 questions. What type of errors involved? What entries are needed to correct for the error? After discovery of the error, how are financial statements to be restated? Companies treat errors as prior period adjustments and report them in the current year as adjustments to the beginning balance of retained earnings. Balance sheet errors. Balance sheet errors affect only the presentation of an asset, liability, or stockholder's equity account. Current year error is to reclassify item to its proper position. Prior year error, restate the balance sheet of the prior year for comparative purposes. Income state errors. Improper classification of revenues or expenses. If it's a current year error, reclassify item to its proper position. Prior year error, restate the income statement of the prior year for comparative purposes. Balance sheet and income statement errors. Counterbalancing errors will be offset or corrected over 2 periods. If company has closed the books, if the error is already counterbalanced, no entry is necessary. B, if the error is not yet counterbalanced, make entry to adjust the present balance of retained earnings. For comparative purposes, restatement is necessary even if a correcting journal entry is not required. Will be offset or corrected over 2 periods. If a company has not closed the books. If error already counterbalanced, make entry to correct the error in the current period and to adjust the beginning balance of retained earnings. B. If error not yet counterbalanced, make entry to adjust the beginning balance of retained earnings. Non-counterbalancing errors. Not offset in the next accounting period. Companies must make correcting entries even if they have closed the books. Change from the equity method. Change from the equity method to the fair value method. Earnings or losses previously recognized under the equity method should remain as part of the carrying amount of the investment. The cost basis is the carrying amount of the investment at the date of change. The investor employs the new method in its entirety. At the next reporting date, the investor should record the unrealized holding gain or loss to recognize the difference between the carrying amount and fair value. Dividends in excess of earnings. Accounted for subject dividends as a reduction of the investment carrying amount rather than as revenue. Reason: dividends in excess of earnings are viewed as a liquidating dividend, with this excess then accounted for as a reduction of the equity investment. Change to the equity method continued. Companies use retrospective application. The carrying amount of the investment, results of current and prior operations, and retained earnings of the investor are adjusted as if the equity method has been in effect during all of the previous periods. Companies also adjust for any unrealized holding gain or loss income amounts and retained earnings in the fair value adjustment account. Chapter 23, Statement of Cash Flows. The primary purpose: to provide information about a company's cash receipts and cash payments during the period. Secondary objective: to provide cash basis information about the company's operating, investing, and financing activities. Usefulness of the statement of cash flows: provide information to help assess 1. Entity's ability to generate future cash flows. 2. Entity's ability to pay dividends and meet obligations. 3. Reasons for difference between net income and net cash flow from operating activities. 4. cash and non-cash investing and financing transactions. Operating activities affect the income statement items. Investing activities are changes in investments and long-term asset items. Financing activities changes in long-term liabilities and stockholders' equity. Operating cash flows are cash inflows from sales of goods or services, from returns on loans, interest, and on equity securities or dividends. Cash outflows to suppliers for inventory, to employees for services, to government for taxes, to lenders for interest, to others for expenses. For investing, cash inflows from sale of property, plant, and equipment, from sale of debt or equity securities of other entities, from collection of principal on loans to other entities. Investing cash outflows to purchase property, plant, and equipment, to purchase debt or equity securities of other entities, to make loans to other entities. Financing cash inflows from sale of equity securities, from issuance of debt, bonds, and notes. Financing cash outflows to stockholders as dividends, to redeem long-term debt or reacquire capital stock. The basis recommended by FASB for the statement of cash flows is actually cash and cash equivalents. Cash equivalents are short-term, highly liquid investments that are both readily convertible to known amounts of cash and so near their maturity that they present insignificant risk of changes in interest rates. Generally, only investments with original maturities of 3 months or less qualify under this definition. Report inflows and outflows from investing and financing activities separately. 3 sources of information for cash flows is 1. The comparative balance sheet, 2. Current income statement data, and 3. Selected transaction data. The 3 major steps in preparing these is 1. Determine change in cash, 2. Determine net cash flow from operating activities, and then step 3. Determine net cash flows from investing and financing activities. Determine the net cash flow from operating activities. Companies must determine revenues and expenses on a cash basis. Eliminate the effects of income statement transactions that do not result in an increase or decrease in cash. Cover net income to net cash flow from operating activities through either a direct method or indirect method. When the accounts receivable balance increases, cash receipts are lower than revenue under the accrual basis. The increase in accounts receivable is subtracted from the income to arrive at net cash provided by operating activities. When accounts payable increase during the year, expenses on an accrual basis exceed those on a cash basis. Sources of information for the statement of cash flows: 1. Comparative balance sheet. 2. An analysis of retained earnings account. 3. Includes all changes that have passed through cash or have resulted in an increase or decrease in cash. 4. Write-downs, amortization changes, and similar book entries such as depreciation because they have no effect on cash. Companies adjust each item in the income statement from the accrual basis to the cash basis. Special rules applying to direct and indirect method. Companies that use the direct method are required at a minimum to report separately the receipts. 1. Cash collected from customers, including lessees, licensees, etc. 2. Interest and dividends received. 3. Other operating cash receipts, if any. Payments are 1. Cash paid to employees and suppliers of goods or services, including suppliers of insurance, advertising, etc. 2. Interest paid. 3. Income taxes paid. 4. Other operating cash payments, if any. Adjustments to net income. For depreciation and amortization of limited life intangible assets, or amortization of bond discount or premium, post-retirement benefit costs, Company must adjust net income by the difference between cash paid and the expense reported. Changes in deferred income taxes affect net income but have no effect on cash. Equity method of accounting. Net increase in the investment account does not affect cash flows. Company must deduct the net increase from net income to arrive at net cash flow from operating activities. Losses and gains. A loss is added to net income to compute net cash flow from operating activities because a loss is a non-cash charge in an income statement. Company reports a gain in the statement of cash flows as part of the cash proceeds from sale of equipment under investing activities. Thus, it deducts the gain from net income to avoid double counting, once as part of net income and again as part of the cash proceeds from the sale. Stock options. Cash is not affected by recording the expense. The company must increase net income by the amount of compensation expense from stock options in computing net cash flows from operating activities. Unusual and frequent items. Companies should report either as investing activities or as financing activities. Cash flows from unusual and infrequent transactions and other events whose effects are included in net income but which are not related to operations. Net accounts receivable under indirect method. Because an increase in allowance for doubtful accounts results from a charge to bad debt expense, a company should add back an increase in allowance for doubtful accounts to net income to arrive at net cash flow from operating activities. One method of presenting this information in the statement of cash flows. An alternate method, net approach of presenting. Under the direct method, company should not net allowance for doubtful accounts against accounts receivable. Company should not net allowance for doubtful accounts against net receivable. Other working capital changes. Some changes in working capital, although they affect cash, do not affect net income. Purchase of short-term available for sale securities. Issuance of a short-term non-trade note payable for cash. Cash dividend payable. Significant non-cash transactions. Common non-cash transactions that companies should report or disclose. 1. Acquisition of assets by assuming liabilities, including a capital lease obligation, or by issuing equity securities. 2. Exchange of non-monetary assets. 3. Refinancing of long-term debt. 4. Conversion of debt or preferred stock to common stock. 5. Issuance of equity securities to acquire debt. A worksheet involves the following steps. 1. Enter the balance sheet accounts and their beginning and ending balances in the balance sheet account section. 2. Enter the data that explains the changes in the balance sheet accounts and their effects on the statement of cash flows in the reconciling columns of the worksheet. Step 3. Enter the increase or decrease in cash on the cash line and at the bottom of the worksheet. This entry should enable the totals of the reconciling columns to be in agreement.